Warren Buffett is often hailed as one of the greatest investors of all time and has built his vast fortune and reputation on a few fundamental principles. While his success is nothing short of legendary, it's essential to remember that even the most seasoned investors, including Buffett himself, have encountered their share of challenges. In the world of finance, it's often said that mistakes are the best teachers, and Buffett's journey is no exception to this rule. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. In this video, we will look into the 10 frequent errors that all investors are prone to make by getting into Warren Buffett's wealth of knowledge and insight. Both beginner and expert investors can learn important lessons to strengthen their financial decision-making and ultimately map out a more fruitful investment course by comprehending these mistakes and the wisdom he has imparted in reaction to them. So if you're ready to learn, let's start the video. Mistake 1. Holding cash. Ah yes, the seductive power of money. The sight of those sparkling coins or green dollars in your hands must be so soothing. However, keeping too much cash is a big no-no in the world of investment, according to the all-knowing Warren Buffett. If they witnessed you stuffing your mattresses with money, they would likely roll their eyes at you. Why, you ask? Well, these investing gurus believe that money is meant to be put to work, not lazing around doing nothing. They suggest that instead of hoarding cash, you should be investing it in quality investments. Because, let's face it, money sitting idly in your bank account isn't going to magically grow on its own. It needs a little nudge and guidance from you to make it flourish. Mistake 2. Market conditions. The thrill of predicting market changes is comparable to trying to catch a feather swept by the wind or predicting the weather in Las Vegas. Warren Buffett must have been grinning at the expense of investors who are overly concerned with market conditions. Why put time and effort into predicting the unpredictable dynamics of the market when you might use it more effectively to analyze specific businesses? You heard that right. Instead of getting lost in the maze of market swings, Buffett advises us to study and understand individual companies. Who needs crystal balls and tarot cards when you can dive deep into the financials, the management, and the competitive advantage of a specific company? It's like being Sherlock Holmes, but with a better chance of making money. It is time to focus on what really matters, the companies that can make you a fortune. Don't be a market condition worshipping lemming. Be a savvy investor who knows where to look for hidden gems. Mistake 3. Diversification. Diversification, as you should know by now, is the holy grail of risk management. Warren Buffett has some thoughts on this common investor mistake. You see, the problem with owning too many stocks is that you end up spreading your assets too thin. And what's the point of that? Are you trying to cover all your bases just in case one of them fails? Well, newsflash, that's not how investing works. It's better to concentrate your attention on understanding a chosen few top-notch businesses. Instead of being a generalist with a limited knowledge base, focus on being an expert in a few topics. By using this strategy, you may thoroughly study these businesses and make wise investment decisions. The truth is that trying to keep track of 100 different stocks would probably result in missed chances and expensive mistakes over time. Don't fall into the trap of excessive diversification. Keep your investments focused and your portfolio strong. Remember that it's quality over quantity. Mistake 4. Risk. The majority of people can manage a small amount of risk in their lives, but risk is best understood as a permanent capital loss. However, Warren Buffett emphasizes the significance of realizing the nature of risk when it comes to investing. The risk of irreversible capital loss is a factor that goes beyond the market's ups and downs. Therefore, wise investors put their attention on capital preservation over the long term rather than being preoccupied with fluctuations in the short term. Another is the danger of equating risk with volatility. At this point, the story takes an interesting turn. The automatic association of risk with the ups and downs of an asset is a typical error made by many investors. They automatically perceive a stock that resembles a roller coaster as being dangerous. Warren Buffett, though, casts doubt on this conventional belief. According to his viewpoint, genuine risk is caused by an investor's lack of understanding of their investments. As a result, there is no need to worry excessively about tiny market swings. As an alternative, focus all of your efforts on deeply comprehending the fundamentals of the businesses that make up your investing portfolio. After all, as Buffett once said, risk comes from not knowing what you're doing. Mistake 5. Best investments. Investing in improving skills and mindsets sounds like such a waste of time and money, right? I mean, who needs personal growth and development when you can just rely on your high IQ? But let's think about this perspective for a second. They may have a hidden wisdom in their peculiar approach. In fact, investing in your personal growth can truly lead to better decision-making, which will ultimately produce better investment returns. It's unexpected, isn't it? The secret is to develop the correct mindset in addition to your IQ, which, truthfully, has its limitations. Maintaining composure and logical reasoning in the face of market instability involves cultivating emotional intelligence. After all, we all understand that selling quickly in a panic is a tried and true tactic. Mistake 6. High intelligence. The secret to success in the stock market, according to many investors, is having a high IQ. What's this, though? Warren Buffett disagrees. I know, it's shocking. According to Buffett, intelligence alone won't make you a great investor. You also need to have the right temperament. You see, it's not about how smart you are, it's about how you handle your emotions when the market goes haywire. Imagine this, you're a genius investor with an IQ off the charts. But as soon as the market takes a nosedive, you panic and sell all your stocks. Congratulations, you just lost a boatload of money. All that intelligence didn't save you from yourself. On the other hand, if you have the right temperament, you can weather the storm and make rational decisions. Instead of letting fear and panic control your actions, you will be able to stay calm and think logically. Mistake 7. Asset allocation. The credo of all wise investors, correct? According to Warren Buffett, it's probably not. He has a different opinion on this. As you can see, the majority of investors blindly follow pre-established allocation formulas without giving value its due. They allocate their resources carelessly based on some formula or general rule of thumb. But Buffett advises you to reject this crowd instinct. Instead of mindlessly following the crowd, they suggest going where the value is. Take the time to understand and find value in individual companies. Remember, value doesn't always mean the cheapest option. It means identifying businesses with strong fundamentals and long-term potential. So forget about those generic allocation models and start thinking for yourself. Be willing to step outside the box and go where others won't. After all, that's where the real opportunities lie. But hey, don't just take my word for it. Listen to the guys who have consistently beaten the market for decades. They know a thing or two about successful asset allocation. Mistake 8. Day trading. Making impulsive decisions based on temporary market changes is called day trading. Isn't it the idea that you don't need a well-thought-out plan when you can just follow your instincts? Warren Buffett, however, would strongly disapprove of this. You see, day trading is like riding a roller coaster blindfolded. Sure, it might give you a rush of adrenaline, but it's also a surefire way to lose your lunch and your money. Buffett has always emphasized the benefits of long-term investing. They believe in taking the time to thoroughly research and understand the companies you invest in, rather than blindly speculating on short-term market movements. So before you jump on the day trading bandwagon, consider this. Do you really have a systematic edge? Or are you just hoping to strike it rich with a stroke of luck? Because let me tell you, Luck is a fickle companion. Mistake 9. Growth stocks. Growth stocks are the shining stars of the stock market. I believe we all want them. Who wouldn't want their investments to increase quickly like magic beans shooting up in the sky? But hold up for a second there. Growth is important, but it shouldn't put your portfolio stability in danger. Warren Buffett emphasizes the value of making investments in businesses you have a genuine understanding of. A plunge into the unknown is what investing in a firm you don't understand is like. It might work, but it's more likely to lead to regrets. So before you go chasing after every new and exciting growth stock that comes your way, take a moment to consider if you truly understand the company and its business model. Do your homework, dig deep, and make an informed decision. After all, it's your hard-earned money we're talking about here. But hey, don't fret. Just because you're being cautious doesn't mean you can't ride the growth wave. Look for companies that have a track record of steady growth and a clear plan for the future. Stick to what you know and you'll be on the right track to financial success. Finally, we have mistake 10. Missed opportunities. This perhaps is the most expensive mistake an investor can make. According to the legendary Warren Buffett, these missed chances are often the ones that cost investors a pretty penny. You know, the ones we had all the knowledge to make but decided to let slip through our fingers. That would really hurt! Just imagine, you stumble upon a fantastic investment opportunity, but wait for it, you choose not to take the leap. And guess what? That missed opportunity comes back to haunt you as it skyrockets in value. Talk about kicking yourself. But why do we let these opportunities slip away? Well, maybe we're waiting for the perfect chance, or we underestimate the value of a seemingly small opportunity. Buffett advises against this folly. He urges investors to seize every chance that crosses their path, no matter how tiny it may seem. Trust us, those tiny opportunities can turn into golden treasures. So dear investors, it is now time to act. Keep those missed chances from haunting your dreams. Instead, arm yourself with knowledge, be vigilant, and seize every opportunity that comes your way. Don't forget that opportunity doesn't wait for anyone in the world of investment. Well then, there you have it. Watch for these mistakes, okay? Let this video serve as your guide in the world of investing. And as always, thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos.